Today I'm going to go through how you take a $42 million property and turn it into a $65 million property. And this is a pretty good example of a deal that we're closing here pretty soon, and this is how we're going to go about doing it. Number one, we're buying this property off market, so that's helping us out right from the get-go, which we've been able to buy about 60 to 70% of our properties off market, which has helped us get really good returns. So from $42 million valuation, which is the purchase price when we buy this deal in about 60 days, and how we're going to take it to $65 million of value. Let me talk about this a little bit first as well. The deal we found off market, it's 372 units. So depending on the unit type, the units are actually under market rent by about 25 to 50%. And so we're going to be able to naturally, not only are we going to be able to take the $2.5 million that we're getting from the bank to put into the deal to do new flooring, new cabinets. No, I'm not going to do too many new cabinets on this one, but new flooring, new paint, new appliances, new light fixtures, new water fixtures, fix up the asphalt outside, fix up the grounds. We're going to be able to add value, and we're going to be able to raise those rents 25 to 50%, depending on the unit type. And I think we're also actually going to be able to get to a point where we're going to be able to surpass the market as well, because I think we're going to have a lot of demand in this area for our apartment communities. So basically, $42 million acquisition price, and how we're going to get to a $65 million valuation in the very near future. So right now, the revenue is $3.953,300. So $3,953,300 is the current revenue at these 372 units. That includes rent. That includes lost keys, like if people lose their keys or get locked out and we have to give them new keys, well, we charge for that, right? We can't just give free keys all the time. It includes damaged apartments that we charge back. It includes application fees. It includes pet fees. It includes amenity fees, pet fees, all of our revenue, right? So that's where the revenue is currently at. Now, what we do is, we make sure that we do charge application fees. They're not always charging application fees. They're not charging necessarily for pets. A lot of times we'll go to these buildings, they say, hey, no pets allowed, and you end up finding out, hey, there's 25% of the units have pets, even though they shouldn't be allowed, and the company's not charging for it. That's a lot of extra wear and tear, right? So we make sure that we're getting our pet fees. We make sure that we're charging what we should be charging, right? What we can charge based on the market. And another thing I want to get into too is we're going to talk a little bit about the net operating income. To really take a property from $42 million of value and a $42 million purchase price, and for our investors get it up to $65 million, it's not just revenue we have to drive, but we also have to be able to control our expenses, because it's the revenue minus expenses, the operating expenses, not including debt. So revenue minus operating expenses that give us the net operating income, or NOI as you hear it sometimes. And the NOI number is the number that will have a multiple on it called a cap rate. And so you're going to take the NOI, you're going to divide it by the going cap rate in the market, and that's how you come up with your value. So talking about cap rates really quick, right? If you hear something that's a 4% cap rate, that means every single dollar that drops the net operating income is a value of $25, right? If it's a 5% cap rate, that means you take the NOI and divide it by 0.05. Every dollar that drops the NOI is a $20 of value to the property. If it's a 6% cap rate, every dollar that drops the NOI is about $17 of value. So when we raise rents $1, right, and that's just for the 1 month, you got to remember we're going to do that over 12. So if we added $1, that's $12 per year. $12 divided by 0.05. $12 divided by 0.05 is $240 extra dollars of value, which would be added to that new purchase price or value of the building. So if we're able to add $200 a month to rent, which 200 times 12 is $2,400. And let's say that it is a 5% cap rate. So we're going to divide it by 0.05. Sorry, we're going to go 200 times 12, 2,400. I'll actually just put my calculator right in front of the, so let's say we increase the rents $200 a month, right? And this is just one apartment, times 12, 2,400. We have 372 of them, so we have 372 units doing that. That's an extra $892,800 of revenue. We're going to take that and divide it by the cap rate. That's an extra valuation of $17,856,000. So that $17,856,000 would be on top of the $42 million that we added. So that's a little bit how the cap rates work. I just wanted to give you a little bit of background on that, because not everyone understands it. It took me a while to truly understand cap rates and how you evaluate properties and all that stuff. So I spent a lot of time trying to teach you guys, what's going on here. So year one, I have an increased revenue of 10%, right? So that's going to take our revenue. That's going to take our revenue from roughly 3.9 to about $4.3 million. And I think this 10% is rather conservative. I think that we could potentially do better than that year one. And so I think it's fairly conservative, because remember, I said that the rents right now are currently 20, 25, 50%, depending on the unit type. They're all different types of units there, and different layouts and different bedroom counts and all that stuff. But us only capturing 10% of that upfront, I think that's fairly conservative, right? So I think that we could surpass this number. Now, expense ratio, I'm gonna say that 40% of our revenue is gonna go towards expenses. And so basically that's the payroll. So our property manager on site and the leasing bonuses that they get, and the leasing specialist and the service techs, they're getting paid, right? Well, the property pays for that. That counts as an operating expense. Operating expenses are not the debt, right? So it's not the debt service, it's not the mortgage. It's only things like the property tax, the payroll, the insurance costs, the utility costs, the contracted services, which is like lawn care, snow removal. If there's elevators and there's elevator contract, that would be under contracted services, pest control, all of the management fees, all of those things. So we're going to assume, and why I have 40% for this one is because this is actually, majority of the 372 units are townhome style living. So the tenants are responsible for almost all the utilities. So that lowers how much expense that we're going to have. And because they're townhomes as well, our rents are a little bit higher than, a normal, just regular apartment. And so when you have less utility expense and some of the less, expenses upkeeping the common area hallways, and your revenues are a little bit higher, that means your expense ratio can be a little bit less, right? If this were a regular apartment deal where it weren't townhomes, I'd actually use the expense ratio of it'd probably be 45% to 50%. But because of this specific portfolio being townhomes, there's less costs on our shoulders as the owner-operator that's going to hit our income statement. So I'm going to say 40% of revenue is going to be expenses, which is $1.7 million. $1.7 million is 40% of 4.3. That gives us a net operating income of $2.6 million. That means at a 5% cap rate, we're at a $52 million valuation after 12 months of operating this deal. So we just added $10 million, 52 million minus the 42 million, we've added $10 million of value at a 5% cap rate. In this environment, we might be able to actually have a cap rate that's less, because this is 372 units, it's desirable product being townhomes. Our cap rate actually might be more compressed or tighter, or less than 5%. It might be 4.5%. It might be more towards 4. If that's the case, this valuation is going to be increased by another 10, 15%. So I'm being really conservative, not only on the cap rate, but also in the revenue increase. So what I've got for year two is I've got increased revenue of 12%. The 12% is on top of this, so it's kind of compounded, right? It's on top of the 4.3 million that we had in year one. The 12% is not off a 12% increase of the initial T12 or what the current operations are right now from the seller, because we'd already be in year two. We're not gonna increase it off of that. We're gonna increase it off the most current number. The reason I went a little bit more increased here is because by the time we're at year two, we're gonna have already gotten through a lot of apartments as far as giving them that new paint, giving them that new appliances, the new light fixtures, the new flooring. We're gonna have the new, the concrete's gonna look a lot better. The grounds are gonna look a lot better. We might have added some amenities to the grounds. So we're gonna be able to get and push those rents and be a little bit even more aggressive. And again, just like year one, I think 10% is fairly conservative. I also think year two, our 12% increase in this scenario, because again, going back to the beginning of this conversation, the rents are day one are going to be 25% to 50% less under than the market. So when I have 10% year one, 12% year two, that's really an aggregate increase because of the compounding of ballpark 25%, right? So it's still on the low end after 24 months. So let's say now we do get the 12% increase on the 4.3 million. That'll take us to about $4.8 million of revenue. Again, expenses are going to be 40%, right? Just because our revenue increases 500, it doesn't mean that our expenses are going to stay at this 1.7. We have inflation going on, right? So, in expenses, as you get more revenue and to increase your revenue, you're going to have more spend to get that revenue, right? Now, do I think it's a possibility that if year two we increase the revenue 12% over our year one performance revenue? Do I think it's possible our actual expenses could be 39%, 38%? Yeah. But I also think there's a possibility that because real estate, our adjustment in real estate taxes could be significant after purchasing this because it's going to get reassessed. I also think it's possible that we could have an expense ratio of 41 or 42% in year 2, right? So I kind of go in the middle and be at 40%. And again, that takes our net operating income to $2.8 million at a 5% cap. So $2.8 million of NOI divided by 0.05 or a 5% cap rate. That gives us a valuation after 24 months of owning this thing of $56 million, which is a $14 million increase over the initial $42 million acquisition price. So that's how we're going to go about doing it. We're going to take the $2.5 million that we have for CapEx, we're going to improve the property, and we're just going to start naturally taking these apartments to market rate levels. And we're going to see significant upside. This is only after 2 years. Our plan is to actually hold this property for 7 years. So as you start to extrapolate this out, year 3, I'm looking at our projections in year 3, I've got the revenue growing 6.5%. Year 4, it's 4.3. Year 5, it's 3.3. So as we push rents in the beginning, we're not going to continuously see the 10%, 12% increases in revenue. That will start to slow down because we're going to get more of apartments to market rate rents. We can't go substantially above market rate rents, obviously, right? Might we get a little bit above market rate? Yeah, absolutely, we might get that. But we're not going to keep pushing at a 12% pace year after year after year for the next 7 years. But the pace that we get on by going, year 3 growth rate of 6.5%, year 4, 4.3, and then 3.3, and so on, that takes us to a valuation that's just north of $65 million come year 6, 7 when we look to sell the building. And on this, we're actually planning on getting we're taking about $12 million. So on this, I'll write this down for the camera here. The deal is $42 million, right? We're coming to the table with $12 million of investor equity. So basically, we're going to have a $30 million loan. Now, get this. Let's just say we don't refinance or anything, and let's say we take that $30 million loan, and this thing is worth $65 in 5 or 6 years, minus the 30, because we're going to pay off the loan, right? Here's the new value. Here's the new value, right, from the operations in year 7, not year 2, but year 7 will be 65. Take away the $30 million of debt, because we're going to do interest only, so we're not going to be paying interest off the whole time. We got $35 million of proceeds, which is almost, a little bit more than right around 3xing the investor equity just on the proceeds. If you we're going to be paying distributions year 1, year 2, year 3, year 4, year 5 as well. So we have a chance to multiply investor equity on this deal by about 4x, 4.5x over that 5 to 7 year hold period on this deal. That's how you take a $42 million property and turn it into a $65 million property.